Hello, welcome to our recap of IFRS 3. This is continuing our groups. Don't forget that you can download all of these mind maps as a PDF for free on the website, or indeed you can buy the full course on which this recap is based if you choose to do so. Remember, IFRS 3 tells us how we do our calculations when it comes to groups. So when you're doing your calculations later on, you can think back to IFRS 3 and it tells us why we need to do that. So it's going to tell us how the acquirer, i.e. the parent, recognises and measures in its financial statements, so in the group financial statements, the identifiable assets acquired, the liabilities assumed, and the non-controlling interest when we buy a subsidiary. So how are we going to value the assets, the liabilities, and the non-controlling interest? Also, how are we going to measure our goodwill, which is the extra bit that we've paid for the entity? Also, if we have negative goodwill, that's called a bargain purchase. So we'll have a gain from that. How do we deal with that? It also determines the disclosures when it comes to our group accounting. So the core principle in IFRS 3 is fair value. So the assets and liabilities acquired are measured at fair value at acquisition. So if in doubt, if you're looking at something in a calculation on groups and you don't know what value to bring it in at fair value. That is the core principle of IFRS 3. It sets out the acquisition method, which is the method that we use for our consolidation, our 5 workings. So we have to identify the acquirer, determine the acquisition date, recognise and measure the identifiable assets acquired, the liabilities assumed, and the non-controlling interest. And we need to measure goodwill or a bargain purchase. So that's the acquisition method. That's the method we actually use for our consolidation. So recognising the assets and liabilities, we recognise them separately. So we take the assets, the liabilities, and the non-controlling interest and we measure them. If they measure the definitions and if they meet the definitions in the framework, then they can come into our consolidation. But they must be part of the business combination transaction. We must be actually buying them. How do we measure them? Well, at fair value at acquisition. Remember, that's the core principle. The assets and the liabilities will come in at fair value. When it comes to the non-controlling interest, we have a choice. We can use the fair value method, which is the share price or the valuation at the acquisition date, or we can use the proportionate share of net assets. And we have a choice to do that. That will also affect our value of goodwill. When it comes to goodwill, we have the purchase consideration, which will be at fair value. That will also include contingent consideration, which we look at later on in the course. But it doesn't include the cost of acquisition. Those costs of acquisition are expensed. So the purchase consideration plus the non-controlling interest plus the fair value of any previously held interest less the net assets will give us our goodwill, i.e. what we purchased it for less the assets we purchased will give us goodwill. When it comes to a bargain purchase, well, if the fair value of the assets is more than what we've paid for the business, so the fair value of the assets is more than the value of the business, well, then what we've done is we've paid extra. So if the consideration, the non-controlling interest and the previous interest add up to less than the fair value of the assets, well then that's going to be a gain for us. We've bought more than we actually paid for. We've got extra assets. We've got a bargain purchase. And if we have a bargain purchase, that's a gain to us and it goes to the profit and loss account. When it comes to IFRS 3, the disclosure requirements are name and description of acquiree, the acquisition date, the percentage we acquired, the reasons for the combination and the goodwill comp, so we need to show those. Also any contingent consideration details, if we had a bargain purchase, and the details of the acquisition if it's been in stages. So that is our summary, our recap of IFRS 3.